Hi everyone, welcome to our research morning call. We have a couple of counter updates today. We have HRnetGroup's initiation, a Phillip on the ground on SPH REIT, and Fortress Minerals results. This will be followed by Banking Monthly before ending off with our Singapore Weekly. So to start off, we have our initiation on HRnetGroup. Our title of higher returns is meant to be a pun that hiring sentiment is returning, and you can expect higher returns from the company. So just to give you an intro, HRnet is the largest recruitment agency in Asia ex-Japan. It has 12 brands spread across 13 Asian cities, some of which you may be able to identify right off the bat, like Recruit Express and HRnet One. Singapore is HRnet's stronghold by geography. It contributes about 55% to FY20's gross profit, and it has two main business segments, namely permanent recruitment and flexible staffing. So permanent recruitment is basically the hiring of perm staff, and this is more commonly used for the hiring of mid to senior positions. And for flexible staffing, it's the hiring of temporary or contract staff. It's the hiring of temporary or contract staff, and this is more commonly used for the placements of junior to mid-level positions. I'll be referring to them as PR and FS. Okay, so in terms of revenue breakdown by sector, FS historically contributes the bulk of HRnet's top line. You can tell from the pie chart and the table on your right, HRnet's revenue stream comes from various clients and industries. The top five clients contributes about 15% to FY20's revenue, and these clients are also long-standing customers of HRnet. That's it. The PR's gross margins are much higher. Therefore, when we look at gross profit, we find that the PR segment is actually a bigger contributor. In other words, while FS contributes stable revenue, PR has a higher flow-through impact to the bottom line. So as mentioned, Singapore continues to be HRnet's stronghold by geography. So now going into its investment merits, HRnet is very profitable. As a human resource business, HRnet's operations generally don't require much PPE, and therefore minimal capex is required. HRnet also has no debt obligations and has a massive cash hoard of 330 million. Having a lot of cash actually brings down the ROE. So to understand the actual profitability of the business, we strip out the cash, and if you can look at the table below, you find that ex-cash ROE generated for HRnet is actually very high. We attribute this to HRnet's strong income generating business, which is built on scale and reputable brands. Employees are incentivized to be productive, and HRnet has also been cost effective over the past 5 years. So reflecting this, HRnet's net margin has been consistent at around 11 to 13%, and this compares to that of key regional competitors, which range from negative 17% to 7%. According to HRnet's latest compilation of ACRA company filings in 2019, HRnet is still the largest and the most profitable recruitment services player in Singapore. So next, initiating the FS business and scaling the PR business is not easy. FS faces high barriers to entry, as this business requires a lot of liquid capital. This is because contract employees are frequently paid upfront before client reimbursements. On the other hand, PR faces high barriers to entry, high barriers to scale. To increase volume, PR actually needs to, PR firms need to be able to manage and train batches of headhunters effectively. And it took years for HRnet to be able to find this golden methodology. Since inception, HRnet has grown rapidly in fast-growing economies. You can see from the table on your right. This has actually given HRnet a greater catchment of candidates, allowing HRnet to provide more staff and increase contract volumes. Lastly, we are expecting a turnaround in hiring to benefit both the PR and the FS business. So generally, employers are more willing to hire during economic upturns. The last quarter of 2020 and first quarter of 2021 saw a rebound in employment for key services sectors. So more than 18,000 and 17,000 new jobs were created respectively, and unemployment rates also came down. Not only so, the rates that HRnet can charge per PR placement has also been going up. This is because companies are demanding for quality employees to be filled on short notices as soon as they are out of their hiring freezes. Similarly, for FS, the FS business has seen a spurt in both rates and volume. Volume is driven by companies requesting for more roles to be filled on temporary or short-term basis. Due to global talent shortages, some companies are even filling C-suite executives on an interim basis before possible conversions within the next 6 to 12 months. In addition, amid the pandemic, some foreign workers are unable to return from their hometowns. And with tightened rules on foreign hiring still in place in Singapore, rates offered for the FS roles have increased. We are expecting the FS growth spurt to offset the slack in other income as some pandemic-related government schemes taper off. So now the last part on valuations. If you can see from the table on your right, sorry, the numbers may be a bit small. HRnet has been able to generate higher ROEs than its regional and its global recruitment peers. Yet, it trades at 16 times forward PE, which is lower than the peer average of 24 times. On an ex-cash basis, forward PE is about 9 times, and with the worst likely over for HRnet, we are expecting HRnet to perform on the back of a recovering labor market. So, in a conclusion, we are initiating coverage on HRnet with a buy and a target price of $1. In our next slide, we have our Phillip on the ground for SPH REIT. They just announced their 3Q update last week. So yeah, just a note, we do not cover the counter. Starting on the key highlights, SPH REIT saw a 22% year-on-year increase in gross revenue for the quarter. This is led by the recovery across SPH REIT's assets, coupled with an additional quarter of contribution from Westview Marion, as well as a decrease in rent relief to eligible tenants. As such, TPU for the quarter increased 11.3% quarter-on-quarter. Portfolio occupancy continues to be high. To maintain this occupancy, SPH REIT provided lower rents on short-term leases. So 6 to 12 months extensions were provided for some leases instead of the usual 3 years. And SPH REIT was also considering to allow tenants to sublease their space to other tenants to refresh their tenant mix. So now going into individual assets, Paragon is their largest revenue contributor. You can see from the table above. Yeah, and if you can look at the chart below, that is the Paragon sales chart, and the blue line is indicative of Paragon sales. So this line is actually still 25 to 40% below the red line, which is indicative of pre-COVID levels. As such, SPH is providing rent relief to tenants on a case-by-case basis. For example, a full waiver is granted to stores like spas, which were mandated to close during phase 2 heightened alert, and that amounts to less than 5 tenants. Waivers of a smaller amount may be still administered for struggling tenants that renewed before COVID. That said, on an overall basis, SPH REIT has granted less relief as compared to that of 2020. This is due to the additional relief provided by the government for the SMEs. Within the portfolio, SPH REIT's suburban and Australian malls were more resilient. Clementi Mall sales held up well as it was close to residential estates and schools which provided a large catchment area. South Australia and New South Wales had limited COVID-19 cases. So the malls located there actually didn't suffer much in terms of sales. In the nearer term, SPH REIT is looking at doing the AIs for the Australian assets. It will be looking at acquisition opportunities in markets like Australia, but the team is also not rushing to complete the purchase. If possible, they want to see the asset before making the decision. So in terms of market color, luxury brands positioned at the first floor of Paragon are still seeing demand recovering. On the other hand, discretionary fashion trades were more challenged as there were less social events for people to dress up. This contributed to the negative rental revergence experienced for the portfolio. With the relaxation of COVID-19 measures to allow 5-pax dine-in, although now it's more for vaccinated individuals, outlook was anticipated to be slightly more positive, given that there was to be more incidental buying as more people spend time in the malls. Yeah, so this is all for SPH REIT. I'll pass my time on to Vivian for Fortune Minerals.
Thanks, Dear Hui, and good morning, everyone. So Fortress Minerals released their first Q22 results update last week, and we see that their results are still very much supported by the strong iron ore prices. So next slide, please. Firstly, on the positives, if you refer to the bullet points on your right, the volume of iron ore concentrate sold increased 62% year on year to about 121,000 dry metric tons. And this contributed to both revenue and PATMI growth. So PATMI more than doubled to 7.2 million, as highlighted in the red box on your left. Some factors that contributed to this increase in volume, first of all, is the lower base. So for first Q FY21 last year, there was a 1.5 month cease in mining operations at their mine due to the MCO back then. And the second reason is also due to the for first Q22, it will be for first Q22, the volume was lower if we compare year on year. So back in fourth quarter of FY21, it was about 150,000 dry metric tons. So if you compare quarter on quarter, it's a lower volume. Yeah. And moving on to the second point, gross profits also more than doubled, with gross margins increasing to 80.5%. And the average selling price, or ASP, was a record $143 per DMT. The average unit cost was higher year on year due to the strengthening of the ringgit against US dollar, but this is a negligible increase. If you can see from the table, it's a 3% increase. Yep. And on the cash flow side, both operating and free cash flow increased to about 9 million for the reporting quarter. So if we move on to the negative, bank borrowings increased to 23 million for financing the acquisition of Fortress Mangapur, their new mining concession. And if we compare the net cash in first Q FY21, it was a net cash of 9.4 million, and in the reporting quarter, this reporting quarter, it was the net debt of $10 million US. But on a full year basis, we are still expecting a net cash position supported by higher net profits on a full year basis. Next slide, please. Moving on to the outlook. So if you refer to the graph on your left, this is the overall trend of iron ore prices for 2021. So from January to July this year. And we are now expecting iron ore prices to remain above $140 per DMT, at least for the remaining of 2021, and most probably over to first half of 2022, according to Bloomberg consensus. And it's currently at about $210 per DMT. This is according to the benchmark, which is the Platts IODEX CFR North China. And the graph on your left is the average China iron ore import prices, which have been trending very closely to the benchmark. So we have been hearing a lot of talk about China trying to cut their steel production. And the major correction that you can see from the graph in end May to beginning of June was also due to that when the Chinese government actually closed down some steel mills, the major steel mills. But on the data point of view, we are still seeing increase in steel production. So for global crude steel production for the first 5 months of 2021, it increased 13%. And for China alone, it was 12% increase year on year. And on the supply side, we are seeing global iron ore shipments falling 5%. So this was recorded in May 2021. Your your international iron ore producers, the major ones are from Brazil and Australia. So for the Brazilian one, which is Vale, they are facing some difficulty in meeting their annual production target. So for first quarter of 2021, it was only 18% of their annual production target. But for BHP, they are still making good progress. But anyway, on comparing demand and supply, and to reiterate, the iron ore is a primary raw material in the production of steel production. So we see that there is some difficulty in closing the gap between this surging demand and the supply that has not been keeping pace. But anyway, for Fortress Minerals, their mining operations have resumed. So to give a bit of background, due to the MCO 3.0, their mining operations were halted for the whole month of June. And they have since resumed operations since 5th July this year, recently. Yeah, they have since resumed operations at 50% of the workers' capacity. So we are expecting, of course, for them to allocate more workers, this 80% to the mining operation side, and for the more back-end staff like your administrative or some parts of finance to work from home. Yeah, so in conclusion, we maintain a buy with a higher target price of 81 cents. This is raised from 64 cents as we incorporate the stronger iron ore prices. So we are now forecasting FY22E ASP, average selling price, to be $140 US per dry metric ton. And this is benchmarked to the ASP achieved this reporting quarter for first Q22. As such, FY22E PATMI has been raised by 41% to $30.8 million. And we expect their production level to increase 10% for FY22E. This is unchanged from the previous update we had for fourth quarter of FY21. Yep, so that's all for me for Fortress Minerals. I will now be passing the time on to Terence for the SG Banking Monthly.
Yeah, thanks, Vivian. So the title of our SG Banking Monthly is All Eyes on the Dividend Cap Review, because this we think is the focus for the month of July, and also we think will be the focus for in August when the banks report their second quarter or first half 2021 results. So, but before we go into this, in our next slide we talk about the lending rates. The lending rates actually rebounded in June. The interest rates actually reversed their decline in June after declining in May because of the move into phase 2 heightened alert. So the 3-month SIBOR and 3-month SOR recovered to 0.43% and 0.24% respectively. The MTLs were also stable as Singapore exited phase 2 heightened alert. Asset quality remains stable, but we expect a slight uptick in the specific provisions for second quarter of 2021 and the general provisions to actually remain stable. In our next slide, we talk about the current review by the central bank, the stress test on the banks for the potential lifting of the dividend cap. So MAS is running additional stress tests on the local banks to assess whether it is necessary to extend current dividend restrictions on them. So to recap, the central bank actually pays a dividend cap, a 60% cap on their dividends in financial year 2020. They can only pay out 60% of their dividends that they paid out in financial year 2019. So the reason why they did that was because they foresaw that there could be significant defaults amongst the weaker corporates, but this did not materialize. So MAS is now looking at whether they can lift the dividend cap. So in our view, the MAS is more likely we believe the MAS could lift the dividend cap because of the significant provisions that they made in financial year 2020. If you look at the table here on your left-hand side, you look at the NPA coverage. For DBS, OCBC and UOB is 109%, 118% and 112% respectively. This is the second last row. So this is way above the MAS requirements by about 30%. So, and in terms of in terms of provisions, they are quite well covered already. In fact, above the regulatory limit. In the last row, you can see the CET1 ratio as well. For DBS, OCBC and UOB, it's 14.3%. And 15.3% both for OCBC and UOB respectively. So what this tells us is that they are very well capitalized, and in fact the banks have enough capital, in fact, to tide through any possible NPLs that they will face. So we believe they will lift their dividend caps, the dividend cap, even though we want to stress that the current fluid nature of the COVID-19 variant in Singapore also adds to the complication of this. So that they could lift, but it could be in phased approach. We expect an announcement on this shortly. We think that they could make the announcement in the next few weeks or in July, or just before the banks announce their second quarter results. In our next slide, we talk about the domestic banking loans growth. So domestic loans growth rose 0.2% year-on-year in May, but tracking below our expected range of 2 to 3% for 2021. Even though the domestic loans growth was below our full year estimate of 2 to 3% growth, but this was still above our expectations because we actually expected May to be slightly weaker as Singapore entered phase 2 heightened alert. But the domestic loans growth still grew, even though business loans was continued to be a drag, but it improved. So business loans contracted 0.5% year-on-year in May for the 9th straight month as loan demand for manufacturing, transport, storage and communication and business services dropped. But the one that held it up was consumer loans, up 0.3% rather on a year-on-year basis for the 10th straight month. This was aided by loan demand recovery in the biggest segment in the housing segment. So overall, when we look at the overall domestic loans growth, loans through the DBU, domestic banking unit, rose 0.2% for the 7th consecutive month, up from the 0.1% in April. So you can see this on the table here on your left-hand side at the bottom. The loans growth actually accelerated slightly compared to April to 0.22% in May. In our next slide, the SDAV for the SDAV for June actually fell 31% on a year-on-year basis to 1.192 million in June as Singapore exited phase 2 heightened alert. The reason why the SDAV fell by 31% in June was because the VIX averaged 17.0 in June, falling from 19.8 in the previous month, as the fall in COVID-19 community cases sent it lower. For June, we expect the DAV to fall as the trading volume had declined to a year low. So if you look at the table here on your left-hand side, you can see the SDAV for June is the lowest for the full year for the first half of 2021. The first half of 2021 it averaged about 1.3 billion to 1.4 billion, but this is in June it's about 1.2 billion. The bright spot though was the derivatives traded. The derivatives traded on SGX rose 6% on a year-on-year basis to 18.1 million contracts. Trading in SGX suite of Pan-Asia benchmark equity derivatives also climbed 8% year-on-year to 13 million contracts. In our last slide, in terms of our value, in terms of our core on the banking sector, we maintain overweight. The banking sector is currently trading close to or below our price to book target of 1.17 times to 1.36 times. The reason why we maintain overweight is because of two main reasons. Firstly, it has traded above 1.4 times in the past 5 years. You can see this on the table, on this graph here on your left-hand side, and also supported by improving ROEs for FY21. We expect the banks to continue to report strong improvements in their net profit, especially as we approach earnings season. We also think the strong capital ratios support the resumption of dividend once the MAS lifts restrictions. We also think a special dividend payout is likely in order for the banks to maintain their ideal capital structure. Like I mentioned earlier on, the CET1 ratio, which is about 14.3 to 15.3%, is above their ideal operating range of 12.5 to 13.5%. In terms of sector pick, we prefer DBS amongst the three banks, and the reason why we prefer DBS is because we expect faster booking of earnings growth from the wealth management unit. Sorry, the previous slide. Yeah, sorry for the technical issue. From the wealth management unit, we expect double-digit growth, and the investment banking businesses, which could drive record earnings in FY21. So that's all from me for the banks. I'll now hand over to Paul for the Singapore Weekly.
Okay, thanks, Terence. Next slide. Okay, I'll just run through the macro in Singapore, some of the key ones at least. In terms of exports, Singapore exports are doing well. I think it's up 16% faster than the prior month, May. I think what was also interesting was that June was the highest, second highest ever on record in terms of our Singapore exports. I think the highest was either February or March. Yeah. The other positive was property. The units was 872. These are new launches excluding executive condo. It is down 13%. But monthly numbers can be volatile and also depend on the availability of supply. But when we combine the numbers and we compare the second quarter of 2021 against second quarter of 2020, we see there's a big jump of 72%. Why this number is important is because it will be a reflection of how the property agents, when they release the results, so we can get some rough indication of the kind of revenue momentum you can get, at least year on year, from the new launches, from the units sold as a whole for the industry. The other kind of key data points were mainly out of the US. So we had our inflation numbers. We take core inflation because, you know, the headline inflation is a bit volatile because of oil prices. So for June, it continues to accelerate. But I think one thing the market is taking note of is that the huge part of the increase comes from, you could say, the reopening phenomena. I think like used cars, because of the shortage of semiconductors. So used cars have surged almost 50%. Airline fares, of course, I think now they're beginning to travel. So these are some of the considerations as to whether, you know, the inflation is more or less one-off, or is it more something that's going to be sustained. The other thing that came out from the US was retail sales. It continues to be very robust, although it's 17% slower from May, but do note that the US retail sales in the past used to track maybe 2-3%. So this time around it's like, I don't know, 4 times or 5 times, more than 5 times faster. Some of the big drivers, and also interesting to note, because these are the categories that will do well once there's a reopening. So we have clothing, you know, up 50, then food service, you know, restaurants, and of course, surprisingly, even electronics is also up. In terms of other news, I think the key one was, of course, Powell's testimony to the Senate Banking Committee. So see, I mean, it's like I think it's a 2 or 3 hours event, but some of the key parts that has been picked up was that he still remains focused on the labor market. So for them, the labor is still not fully recovered. So there's no reason to raise rates or tighten yet. Then what they see is that it will be a mistake by them if they were to react now and tighten if the price increase or inflation is just one-off. And of course, there is a caveat here. So what they are saying is that if it gets longer, I mean, if inflation continues to persist, then you have to reevaluate the situation. So I think the tricky part will be once you hit the fourth quarter, maybe November, December, and if inflation numbers are still stubbornly high, then there's a high chance that he has to tighten up. But I think the next 1-2 months will still say. We'll later discuss on Phillip on the ground on Uni Asia. They had a poems webinar with us. It was done not last week, but the prior week. But since we didn't brief, so we'll just try and have a quick brief later. In terms of our tactical views, we remain positive on the market. I mean, at least for the backdrop, interest rates will remain conducive. I think even though with the higher inflation numbers, I think the 10-year bond yields were still, I think they were down, or at least at the very least flat at 1.3. They didn't even react much to the inflation news. And also, what we're beginning to see is that, about maybe in the first quarter, the market was very worried, was taking the lead that interest rates will rise. But I think now they're beginning to realize that how the Federal Reserve views the economic conditions is more important than what the market thinks. So long as the Fed still says the inflation is not worried, then I think the expectations of raising rates won't be there. The second one is more Singapore-centric. So although we had this hiccup in the surge in cases, I think we still believe that the reopening is on track because of the vaccination rates are meeting the timelines set by the authorities. I think we'll give more details later why we think so. In terms of the weeks ahead, of course, today will be the so-called Freedom Day by the UK. I guess it's going to be a nice experiment because they're probably taking the pandemic as an endemic kind of situation to the extreme, maybe. The others would be results by some of the big US companies like Netflix, Peter, just for you, reference. On the 23rd, I think something interesting, I mean, in line with the theme by Terence, the ECB will be considering the dividend cap. For those who don't know, I think in late June, the Federal Reserve removed dividend caps for the US banks. Then right now, there is still a dividend cap on the European banks. I think it's like 15% of their 2019 earnings. So by 23rd, they're going to announce whether they're going to remove it. So of course, if they remove, I'm not sure what's the impact on the Singapore banks, but of course, I'm pretty sure that the authorities here will also kind of take note that if other countries are removing, then why are you still having the cap? Of course, we also have Singapore CPI numbers. In terms of POEMS events, these are the ones. I think next week we have OTS, which is the new IPO, the most recent IPO. Other notable POEMS webinar we're going to have will be, of course, Capital Land, and also the large ones will be NetLink Trust. I think the rest out there, I think if anyone's interested, no, feel free to register. This is open for everyone. Next slide. Okay, as usual, we'll just start with how the pandemic is tracking. I mean, just a quick reference. As usual, we will look at the blue line. So you can see that we are having another resurgence due to Delta. And hopefully we don't get this huge third wave, which is happening in a lot of Southeast Asian countries. I hope because of the vaccine level of vaccination, hopefully this time around we won't get that huge wave again. Next slide. Of course, what we are facing now, I think we can see from the news everywhere, is the big surge in Southeast Asia. So the red line is Indonesia. They're facing this big, humongous third wave of cases. You also can see it's a bit faint, but you can see from Malaysia, there's also another third huge wave underway. Also important is Thailand. It's a bit harder, the green line. But why this is important, as you know, this is going to be a big impact on Thai beverage. You know, Thailand is really expanding their lockdowns. And also, Thai Bev also has exposure to Vietnam, which is also extending their lockdowns to southern parts of Vietnam. This line is this on the table on the right is just some of the European countries. I think most are still trending down with a small spike, but you can see that UK is having a big spike. I think the latest number is 50,000, which is almost to their record highs, but they still are looking to reopen. So it'll be interesting to see what actually happens then. Next slide. Okay, this is purely on Singapore. I think if you purely look at the data, I think the cases that we have now is very close to circuit breaker. Just to give you some sense, during circuit breaker, the average daily case, average case per week was about 50, 54. You can see from there. It's a bit small for some maybe. But right now we're having 47. So we are almost at circuit breaker levels. We have like 300 cases, the first bullet point. But I think the difference now, I think this is because I've been following all the ministry task force briefings, I think this is probably the first time that they emphasize what are they looking at, apart from daily cases, which they feel that there's a sense that it's not as critical. So what they're looking at is the ICU, the number of people in ICU. So in Singapore, the ICU capacity for COVID is about 1,000 beds. Right now, there's only one. But I think what they're monitoring is that based on experiences in other countries, that one can fill, the whole 1,000 can be filled up within 5 weeks. I mean, I think the minister gave an example, 25 to 50 to 100. So you can calculate yourself the doubling. So until we see ICU capacity start to surge, which I think they update every day, I don't think there will be any change in the way they view the pandemic as endemic, or I don't know, the so-called common flu phenomenon, where they won't lock down everything and they will only kind of tighten the lockdown measures if they see the ICU capacity starts to fill up. The other piece of good news is the vaccination levels. So the first dose is 73. This is important, I guess, because eventually those with first dose should be able to get their second dose. And so if we can hit that so-called herd immunity that they're kind of looking at around 80%, so there's a good chance that we will still be on track for more aggressive reopening. And if you just do some rough estimates, because the country now is vaccinating about 66,000 a day. So if you assume all those having first dose getting their second dose, within less than a month or 22 days, those on the first dose can get fully vaccinated. So we can even hit that 73% on paper. This is theoretical. On paper in a month's time. So what all this means is that we are still confident that the authorities, based on their level of vaccination, should still be open to reopening as we hit the vaccination milestones. Next slide. Okay, this is just a graphical illustration of some of the macro data that came out. So the table on the left is just to show the electronic exports growth. So the blue line is the blue line is exports, and the red line is electronics. So you can see the big rebound in exports. Again, this is just for illustration. The table on the right is just the number of properties, new launches sold, excluding executive condo. I mean, we take out executive condo because executive condo can be very lumpy, so it may not be may not show the trend because sometimes one quarter might have a big EC launch and then the numbers get all skewed up. So you can see that in the second quarter, we had about 3,000 units sold. But in the second quarter of last year, we got 1,007. So we're going to get this big 70% jump. So this will help the property agents in their second quarter earnings. Next slide. Okay, this is just again an illustration of the numbers that we see, the data points that we see in the US. So the table on the left is US retail sales. You can see the big spike, the big jump, the red line, the big jump in growth for US retail sales. Of course, some might say that this is due to last year there was pandemic, this year don't have, so you get this big jump. But when you look at the blue line, which is the total sales over a 12-month period, you can see that the retail sales in the US is record levels. So even if you remove the pandemic, you can see that these are huge spending by the US consumer. So there's a huge economic momentum in the US. And then at the same time, you have high inflation numbers. So in a way, the high prices are being absorbed by the US consumer. I mean, one way to read it. Next slide. Okay, we decided to do this because there are some listed tin companies in Singapore. I think it's mainly Malaysia Smelting Corp, which is owned by Straits Asia. So we wanted to because very seldom you get a commodity that has just reached all-time high on record, never has it hit this level. So the blue line just shows the tin price. The red line shows basically shows the inventory at the LME. So what has happened for tin, at least, is that the supply, there's a big shortfall in supply. So supply is 327, you can read yourself. I think demand is 347. So there's a big disruption in supply. What has happened is that Malaysia's smelting corp had to close because of the pandemic. Likewise, even for PT Timah in Indonesia. Or if they don't close, so the production is kind of been hit by the pandemic or the lockdowns and so forth. And demand has been strong because tin, the use of tin is 50%, which is basically electronics, then chemicals, and then tin plate, you can see that. The third bullet point is just to show you some of the listed companies. So the big one is actually in China. China is also affected because they rely a lot of tin supply from Myanmar. And then you have PT Timah from Indonesia. And of course, Malaysian's Smelting Corp is owned by Straits Trading, and it's also listed in Singapore and Malaysia. Okay, next slide. Okay, this is for those who did not attend the Uni Asia, just to give you a sense of what they're saying. So Uni Asia is they are a dry bulk operator. So for those who don't know, dry bulk means the type of vessels that carry iron ore, which Vivian just mentioned. Then they also carry grains, and they also carry coal. And they also have some property projects in Japan and Hong Kong. So I just go to the third bullet point. So what is happening right now is that the dry bulk freight rates are hitting 10-year highs. It's a bit hard to see, but you can look at the chart on the right. It's actually 10-year high for freight rates. And the three reasons they mention why the dry bulk rates are so high is that there's a big rebound in demand, especially for China. I mean, like if you're shipping iron ore or coal from Australia, Indonesia into China, or even to Brazil, so they need all these dry bulkers. The second is supply. Since, as you can see from the chart on the right again, the rates have been so low that I think nobody wanted to order anything, so supply has been low. Then the third thing is that there's a disruption. So a lot of ships can be stuck at the ports because of the pandemic. It takes time to discharge, which is to unload the cargo and also to load cargo at the ports. So all this pandemic kind of causes some bottlenecks. The next driver to the share price will depend whether they can sell. How's the selling rate for their fourth and fifth office project in Hong Kong? I think the rest I won't go through a bit too detailed. Next slide. Okay, this is my final slide. This is just to show what are the results coming up for this week. I think the big one, there's going to be an update, I think SPH, then the rest is for everyone's reference. I think SATS and then SIA Engine and also iFast. I think it's probably some of the larger companies and some of the Maple Tree. This is just for everyone's reference. We took it off from Bloomberg. Okay, thanks everyone. I think we can move on to Q&A. Okay, let me just answer the first one. Just a reminder, if you have a question, just tap at the Q&A tab. So let me just read out this first one since it's ranked the most. Hi Paul, is IX Biopharma share still a buy now, or should we buy the shares of Lego Pharma instead of if it is successfully listed on Hong Kong Stock Exchange? Okay, there's a bit of background. IX Biopharma has announced on the SGX that they are taking most of their business except the smaller nutraceutical to get listed on Hong Kong Exchange. I think we didn't write a note because there wasn't really much to value add. I think ultimately it depends on the market cap of Lego. That's why it's called Lego Pharma, rightly mentioned by the attendee. So they're going to do a separate listing, not separate listing. They're going to list some of their major operating business into Lego into Hong Kong. My own view is that it's probably better to stick to IX Biopharma. The key thing to watch, then the reason why we didn't write is because we're not sure what is the valuations there. But I mean, logically, I don't think the IX Biopharma is going to go through all the trouble, pay all the fees. I don't know, I think it costs a few million just to do this exercise, my guess, and get something where the valuations are lower than in Singapore. I think there is one recent listing, if I'm not mistaken, I'm not very familiar, KeyMed, there's one listing in Hong Kong, KeyMed. I think the market cap in Sing dollar is almost 4 billion, and the company is making, I think, 100 million of losses. So the main purpose, I believe, would be, of course, to raise money, number one. Number two would be to get a bigger valuation from Hong Kong. So my own preference is maybe to stick to the IX Biopharma part because you might get this valuation re-rating. Again, I have no idea. If they get a big jump in valuations in Hong Kong, then it could also help the share price here in Singapore. Yeah, I think that's my own view. Then maybe whether is it better to buy the Hong Kong? I really don't know because it depends on the volume, the liquidity, and the take-up. But of course, if the volume there is better, then it should be better to buy over there because ultimately it's still the key company, and you always want to buy the direct exposure, which is the Hong Kong arm. I need us to cut the story short. We still have a buy on IX Biopharma. And the valuations in Hong Kong can be a big catalyst. Again, depend on the valuation, depend on what kind of valuations they get, which I have no idea right now. Yeah. Thanks for the question. Okay, I think we can move on to the banking ones, then we go to Bayron. Yeah, thanks.
Okay, yeah, thanks, Paul. So there are a few banking questions. I'll just address, just read them, the top ranking ones first. Do you think the normalization of dividend has been priced into the bank stocks? So we don't think so because the manner in which they will lift the dividend cap is still uncertain now, and also when they will leave. Of course, internally we expect the banks to leave it, the MAS to leave it in this month, but they could leave it in two phases as well. So maybe they reduce the dividend cap in two stages. So because there's still uncertainty in terms of when they will do it and how they will do it, the market has not priced in the normalization of dividend into the stock yet. Yeah. So let me know if I answer your question. I'll go on to the next question. What do you think of local banks if digital bank coming? So the monetary, they've already issued the digital banking license already. They've issued the full banking license to some of the players like Grab and Singtel. So in terms of the impact to the local banks, especially in Singapore, we think that the impact will be quite muted, mainly because Singapore is already very well capitalized already. I mean, the penetration of the bank is already very well penetrated. So and the banks have also invested a lot in digital efforts over the years. So we think that if anything the impact is quite muted. In terms of the overseas impact though, I think the digital banks will have more headroom when they go overseas. Sorry, I think there's a bit of disruption here. Maybe, sorry, can anyone take the next question first? I'll come back. Yeah, thanks.
Okay, hello everyone. Maybe I will take the question on Fortress Minerals that came in quite early just now. So the question is, it was mentioned in the presentation that China closed 3 major iron ore or steel mills. What are the names of these mills, and can you share on how this will affect Fortress Minerals? So yeah, earlier in my presentation, I mentioned that the correction in the iron ore prices to explain the trends in the iron ore prices. Sorry, yeah. The correction was due to China, the Chinese government announcing trying to cut the steel production, which is causing a lot of pollution. So the major steel mills that were closed, regarding that, they are actually located in Tangshan, which is a top steel making city in China. So there were around 7 blast furnaces that were shut at 4 steel mills, and the blast furnace is actually this very long, put it simply, like a pipe to produce your steel products. Yep. So the steel mills include, if you're interested, it's I think Yanshan, Tangshan, and a few others. I think around 4. Yeah. So that's why the iron ore prices kind of corrected. But actually in July, early July, it was also announced that some of them, or most of them, they have actually resumed the steel production at about 70% of the original capacity. And anyway, we were trying to look at, how the factors affecting the iron ore prices, one of which, the biggest one, would be the China steel production, because they are they take up around 70% of the total iron ore produced by produced globally, and mainly is contributed by your major Brazilian and Australian iron ore producers. Yep. So anyway, they have resumed production, and even if we look at the iron ore prices kind of trend, it's overall increasing trend. So that's why we are still expecting iron ore prices to be strong for the remaining of financial year 2022 for Fortress Minerals. Yep. So anyway, to wrap up, they will affect Fortress Minerals in the sense that how they affect the iron ore prices, but because anyway Fortress Minerals produces for the Malaysian steel mills, so in that sense they wouldn't affect the production. Yep. So hope that answers, and that's all for me for now. Yeah, thank you.
Yeah, thanks, Vivian. Thanks for taking the thing. Sorry for there was some disruption here early on. Others can carry on. Just to recap, there's a question on what you think of local banks if the digital bank is coming. So I think to summarize, in terms of the impact locally in Singapore, we think the impact will be quite muted because the banks are already very well penetrated in Singapore. I think they can probably capture some pockets of growth in some areas, but the impact is likely to be very muted in Singapore, especially because the local banks have invested a lot in the digital space also. So the value add that they can do, we think, from the rest of the players will be quite limited. We think the growth though will come from overseas, like in the Southeast Asian markets, where the banking penetration is lower, especially in some of the emerging countries like Cambodia, Vietnam, and Myanmar as well. So because of this, they could probably capture more growth in those areas. But this does not mean that the bank's operations in those countries will be impacted also, because it's a growing market. So the pie is growing, so the banks can also still compete there as well. Yep. So I'll go on to the next question on the banks. US banks corrected after release of good results, lifting of dividend, etc. Will this happen the same in Singapore banks? So even though the banks reported good results, but one of the main reasons why the US banks corrected was because of the lending growth slowing. So I think there was some concern in terms of whether lending growth they will be able to continue to drive lending growth, which will obviously affect on NIMs. So for the Singapore banks, I think the situation is slightly different. The Singapore banks, we think there are a few main catalysts for them. Obviously, the NIMs have generally stabilized. The wealth management business is still expected to grow by double digit, and also because of the reversal of the general provisions, the banks, we still expect to see the banks report record profits this year. So we think probably less likely that they will correct. Of course this will again depend on the results. And of course we think the biggest problem affecting the banks now will obviously be the main thing affecting the banks now will obviously be the economic situation. And right now, because of the COVID-19 situation, I think like what Paul mentioned in his slide, because of the COVID-19 situation in Singapore, the spike in the number of COVID-19 cases is adds an added uncertainty in terms of the reopening and whether we are going to see further tightening measures, and that will obviously impact the bank's results. Yep. I'll go on to the next question. What is SDAV and the other acronym used in the slide? So sorry, we didn't define. So SDAV is Securities Daily Average Volume. So what it does, how they calculate the metric is to look at the total average volume traded in the month, and then they divide it by the total number of trading days to give you what the average volume is on volume traded every day. Thanks so much for going to this slide. Yeah, so if you see here, because the volume can fluctuate on a day-to-day basis. Some days is higher, some days lower. So they just try to get an average in terms of what's the total trading volume in a day. Average on an average basis. Then there's DDAV as well. DDAV is the derivatives daily average volume. It's the same calculation. You look at the total derivatives traded in a month, and then you divide it by the number of trading days. And then I think there's one more probably which is the VIX. So VIX is the volatility index. So what it does is to track the volatility in the market. Yeah. Thanks for clarifying. Let's see if there's any more questions before I hand over. Yeah, I think that's all from the banks. I hand over to my colleagues. Thanks.
Viren, you want to do all the technicals? Yeah.
Yeah, sure. Sure, Paul. Just give me a moment. Okay, so let's go on to some of the questions that I have. So unfortunately, I think there's a lot of questions for my colleagues as well. So I'm going to answer all the questions on the tabs here, and then I'll stop, and then I'll pass on my time to my colleague. So it's now 12:08. So without further ado, let's start. So first up, I think there's a lot of like vested interest on REX International. So for REX, right, prices has already broken out of the panel, or you can call it a symmetrical triangle. Issued this report back in March. I can't remember. I think mid-March or early March or mid-March, and then prices has already reaches my target price too, and then subsequently it goes all the way up, breaking the what do you call it? Okay, sorry. Okay, so breaking this resistance zone at 0.200, okay, 20 cents to 21 cents. Prices has already like formed a very strong bull upside. Today there's a gap down, but I think price is looking to test, return to a throwback to test 0.210 before continuing on the upside. All right, so if you can see on the weekly chart, prices will in a very long run, you'll test 0.360, especially when the oil prices right now is still on the upside above $70 per barrel. I think REX is poised for a strong upside. All right. So next one will be ST Engineering. ST Engineering, so far I remain neutral on ST Engineering, but will this resistance zone at $4.01 to $4.16 break? I think there is a possibility because first of all, the resistance level has been tested multiple times. The rounded bottom over here, and then the larger double bottom is trying to break on the upside. So once it break on the upside, we can look at $4.40 for the next immediate target in the midterm. So right now, when will it break? I'm not very sure. Therefore, for ST Engineering, that's why I remain neutral on that. Okay. So for the next one is the bull state. Okay, so bull state, support zone remain at 0.97 to $1.06. Bull state make a ABC kind of like a correction. So I foresee price will have a slight correction, preferably to 1.12, and then therefore a rebound after that for bull state. Otherwise, you can wait for a breakout above $1.24 if appropriate. Otherwise, I think 1.12 will be a better price to wait for a rebound on the upside. All right, so decisions are up to you. Okay, so next one, I think Sheng Siong is very interesting. I think Sheng Siong this morning has gap up, but price remain bearish. So if this turn out to be a bearish, it will be a mini island reversal. Means that price is likely to correct down, which I mentioned that before, that $1.48 to $1.51 remain a very strong support going forward. Okay, so Sheng Siong, I know that uptrend is the upside is there, but I think there's a low period of volatility. Neither strong selling nor strong buy is observed other than in mid-May. So hence, I think this one will be a 1, 2, 3 wave pattern, rebounded and then rebound and break the upside of the resistance zone going forward. That's what I believe for the Sheng Siong. All right. So next one will be HRnet. I think someone asked about HRnet. HRnet going to $1 possible. I think in fact it will go beyond $1 actually. First of all, I think if you look at the weekly chart since its debut, prices has really broken out of the upside. So if you look from the wave perspective, this subwave 1, 2, this is wave 1, 2, and then this is extended wave 3. So extended wave 3, once it clears 0, I think 0.880 will be the next wave, and then some slight correction, and then you go to 1.02. That will be the ultimate wave 1 of the larger wave wave phase. Okay, so let's go back to the daily chart. What can we expect? So price has already make out a strong upside. I think start of April I issued a report on the HRnet, but unfortunately it hit my stop loss before it rebounded to the upside. So hence price is going to likely find some sort of like a retracement. 1, 2, 3, touch the support over here at 0.720 before a rebound to the upside again. Other than that, I think HRnet long-term wise, I'm maintaining the very strong upside for it. Okay, let's move on to the Hong Kong counters. I think How High Biotech, I think someone asked about it. So far, not much comment about it. There's a strong selling, followed by a rebound. Means that I think price is slowly going to edge up to $14.141.1 to 150 before a strong selling again. This is the support zone at 103.94.1 to 103.4. All right, so price is likely going to break 122.5, and then once it break, you will target 144.9 to 150 region before on the upside. Okay, before correction down to the downside again. Grade 1 also price rebounded. So this resistance zone, I still maintain it because first of all, these candles are consolidating. So once it's consolidating, it can either break on the upside or the downside. To confirm the upside, $30 need to be broken. It's because it's a psychological resistance level. Once it's broken, then we can target $33.50 going forward. But will it break $30? I think it will. First of all, I think price already confirmed the upside, the infancy of the upside when price already has already broken out of the falling wedge. Okay, so you can see that price is actually on the strong uptrend since March 2020 on last year. So this correction is now like a larger downtrend correction. Is larger in response to this larger wave, upside wave. Okay, so price is likely to break. Once it break $30, then we can see a next target of $33.50. All right, that's my view on Great Wall Motor. So let's move on to the next one at Ping An. Ping An, I said I hate to say that, but Ping An, even there's a rebound, the upside will be capped at 75.80. If it breaks, the ultimate level will break is at 78.65 to 79.85, and then there will be some more downside going down again. All right, so that's for Ping An. Ping An is still on the downtrend. And then you see on the weekly chart, the falling wedge has been broken. So support zone 2 is likely to be the next rebound, but the rebound is likely to pull back and then goes down once again. So Ping An, I foresee there will be a very strong bearish downtrend going forward again. Tencent, still bearish despite some major support, some rebound on the major support. The bearish sell down today will likely to break down below. Reason why is because the support term resistance zone has been is strongly resisted, and then there's like some sort of like strong selling today and weak candle formation on last week. So that's the reason why I am like on a strong selling. Okay.
Can you do MM2? Since so many people asked, then I will take it off.
Okay, I'll do MM2. I'll do MM2 on the last part when before I do. Okay, is that okay, Paul?
Thanks. Yeah. Thanks so much.
Okay, so so Baba for Baba still remain neutral. I believe that the real rebound will happen at the lower bound of the support zone at 184.42. Once it forms like a falling wedge kind of pattern over here. So let me see, some sort like this, and then you will just have a breakout. And then if it breaks the resistance zone, then that will be a very great news for that. So APAC Reality, I think Propnex is the one that also have exceed all my target price when I received the report. I think within 1 week it exceed all my target price 1 and 2. But for APAC, it has reached its ceiling at the resistance zone at 0.825. Hanging Man was there, and then there was a slight retracement, which I foresee that there will be a rebound at the support zone at 0.690. Unfortunately, it falls short, and then it just go on the upside. But right now, I'm not very sure on whether you will go up or you will just have a correction because of this formation candle and this inside this bar that's hidden within it. And then last Thursday, where it rejects, there's a bullish candle, but it rejects the resistance zone at 2.618% of the pennant. All right, so it means that this upside is actually growing very strong. So I would still say that I'll wait for 0.745 to 0.775 for a rebound on the upside. Okay, next thing is Baidu. Baidu, I'm still on a bearish downtrend. Descending triangle, long-term support zone might be broken, and then so hence see, if this is supported, that means that the descending triangle over here is proven to be a bearish downside. All right, a bear trap, and then there'll be a rebound thereafter. Okay, so UMS, I think there's a divergence here, a little divergence that you can see over here. So price actually has broken out the immediate the resistance at 1.46 to 1.49. So it is right now a key crucial immediate resistance and support zone. Any rebound will occur near here. All right, and another thing is we shall see what's the candle formation today. Is it going to be on a strong upside or downside? Let's see for going forward. Okay. AEM at the same thing, like UMS, this is risk resistance zone 1 has become a support zone. So hence, if this is like a dragonfly doji or a hammer, then I think that it is a good chance to accumulate for a buy to break 4.42 and then target at 4.59. For Franken, the shooting star was like kind of like confirmed, but the downside was like more like a correction. So I'm still waiting for this support at 1.70 to 1.74 to hold. Another thing is you can wait for this crucial support line, which is now the resistance line, to break above. And then once you break above, I think you can confirm the bullish upside thereafter. And then price will actually proceed to break $1.92 and then followed by $2.10 thereafter. China South International bearish diversion is much stronger. Price has already has an infancy stage of breaking out the rising wedge. Hence, I think support zone at $11.26 to $11.86 will be the next crucial level to watch out for. All right. Okay, so Single Energy, not much update. Just that this bearish gap zone right now is filling. So this is a consolidation candle. So it can means that it can form the pennant or the flag kind of like pattern, and then it breaks up on the upside, or it can just continue to go down to test a lower support zone. Means that this one may be a bull trap. So much data will be needed. So any confirmation on the upside, you need to break $20.42 to confirm it, and then followed by a target of 22.64. This is what I believe that going forward, this energy. This is the move going forward. So do look out for all these price level that I mentioned. Right, but given this, I think this one will be more of like a short correction and then breaks up on the upside to this level. So this is what I believe for 1799. So lastly, I think Hong Kong Exchange inverted head and shoulder once again, and then breaks up of this weakened resistance zone. Now it's a support. Strong bullish candle was up here, was supported last Friday, and then price is either going to test on the upside once again. All right, so without further ado, I think the last one I will do MM2 on the request on Paul. Okay, so MM2, there is like I'm quite positive that you reach $1 in the long run. Despite that there's a correction today, since last week. I mean, sorry. But this multiple resistance zone, they can see is actually kind of like being testing. All right, so if this level at 0.6 is well supported, this is a hammer. If you close as hammer, then there is a possibility that there will be a move up and then target at 0.90 cents, 0.90 to 10 cents. All right, that's what I believe going forward. Okay, you can mention that this may be a triple top, or this is a rounding bottom. All right, or this one may be a head and shoulder. It's really entirely up to you to interpret. But from all angles, I think I will maintain that this resistance zone 0.078 to 0.084 is kind of like weakened right now. So yeah, that's all I have for now for the technicals. The rest, like I see some of the question like Capital Land, NIO, Maple Tree Logistics Trust. You can look out for. You can check out my stocks BNB technical report at www.stocksbnb.com. Most of the reports are there, and most of the content that you ask are quite recent. So I pass my time to back to Paul, and then yeah.
Yeah. Okay. Thanks, Viren. Actually, it wasn't me. I mean, I just saw some of the requests at the bottom, so I thought just do it. Then after I answer the MM2, then we just hand it over to Natalie for some. Okay. The question is, what do you think of MM2? Is it still a good recovery play? Okay. For those who don't know, just to give a background, I think the auditors mentioned that there's material uncertainty over it as a going concern because of the debt involved. we are still, I think we still think it's a good recovery play, but I think the thing is that there is a lot of risk here. Just to refresh, as of their most recent results, so they have like 12 million cash, but they're burdened with I think 200+ million of borrowings, and also don't forget there's another 80 million of trade payables. I think we are not naive. I think when you have an event like this, you always worry whether any of your creditors start to push for repayment early. I think if you trigger any issues with the trade payables, it could cause a chain reaction. I mean that's the worst case scenario. Anyway, our optimism is purely thematic. I think from a macro basis, I think why we like it because they have a pipeline of almost 100 million of projects to be done. The reopening is underway. I think we hope, which we are still confident. Number two, number three, there's also some restructuring at the cinemas. They could merge with another competitor. And number four, the IPO should be is still on track. I think they submitted some documents. I think it's still on track for IPO, and that could actually deleverage the balance sheet also. But again, this is a high risk bet now, obviously, because of the amount of bank debt and also trade payables. I mean, whenever any company comes to this situation, I mean, not for them, but any company, you always worry what happens, how the trade creditors react, whether they want to enforce anything, and then they could cause a spiral. But obviously, this is some of the risks. But in terms of deep recovery plays, this is the one. I mean, yeah, for MM2, that's just our view. We don't have coverage, by the way, or no official rating. Move on to you, Natalie, on some of the questions.
Hi, good morning, everyone. Just give me a minute to turn on my camera. Okay, so I think I'll start with some of the questions from CapitaLand. Okay, my virtual background is gone. Okay. Yeah, sorry, my virtual background is gone. So just bear with me. I'll take some of the questions about CapitaLand first. So some of the questions are, please comment on the CapitaLand restructuring. Why has the price not moved? And also, there's one more below, if I can find it. Okay, so I think for CapitaLand, the general commentary is that as the timeline progresses and as CapitaLand actually gets approval from SGX, which they have already gotten, I think just a few days ago, and today they released, or rather over the weekend, they released the scheme documents. So as the timeline progresses, we see them moving towards the deal, and of course now the timeline is more concrete. We see that the EGM will come on the 10th of August with eventual delisting coming around 17th September. So I think as the deal progresses, we see that the demerger has not yet been voted down. In fact, it was voted in favor by the SGX and allowed to proceed, of course. So that will definitely give a little bit more confidence to the investors and help to move the share price a little bit. So as of since Friday's last close, the share price is up by about 1.3% already. Yeah. Okay. And just to wrap this question on CapitaLand up, I think we are very much in favor of this deal. We think that it's a good deal for the unit holders. Some of the reasons include that we believe that the decoupling of the development business from the fee-based business, for example, from the management fees earned from the REITs, as well as the lodging platform and the stable income from the properties that they hold on the balance sheet, we believe that this will help re-rate CapitaLand on higher valuations. Yeah. So instead of how developers used to trade, or CapitaLand specifically, where they've always traded at a 20 to 25 discount to NAV, moving on to this asset-like model will actually cause us to value the company differently based on more of a multiples approach for price to earnings. Yeah. Okay.
But sorry to interrupt, Natty, but the details is not out, right? Like how large the new entity is that one of the reasons what's holding it back to, like, there's no announcement of like how much earnings is inside there. There's no real details, is it?
Yeah. Okay. So that scheme document, it's a very comprehensive document, about 100 over pages. And also another one, the intro documents to list CLI. Sorry, so they've changed their name. They're no longer calling themselves CLIM, CLIM. Now they're calling themselves CLI, Capital and Investment. So this document, the 100 pages and the 77 pages, they were released on the 17th, so on Saturday actually. Yeah. So we had a call with the management earlier, and I think later I'll be going down for a second call. Second briefing with regard to this demerger, so we have more color on how we should view this new entity and their directions and how they're going to take it forward. Yeah. So the details, including the pro forma statements for 2019, 2020, as well as for the first 3 months of 2021, have been released as of this last Saturday. Yeah. Okay. So done this. Okay. So I think there's also another question about Parkway Life. Oh, and also on Tasin. Okay, I'll take the question on Tasin. So Tasin, for those of you who have been following, Tasin actually suffered almost 25 to 30% decline in share price. This was, we speculate, we don't really have any evidence for this. So we speculate that it's because of the loan maturity that's coming up. So this loan was actually taken at the start of the IPO. It was supposed to expire in January, on 20th January 2021. So that was this January. They sought a 6 months extension from the lenders. So that means that the new expiry date would actually be about today. Yeah, so of course, as you know, REITs, they usually borrow, they are levered kind of creature animal, so they will borrow, and then they, instead of paying off the loans, they will actually roll over and refinance the loan. So for Tasin, their loan is up for refinancing, expires today. So we should hear any news from them with regard to this refinancing, be it positive or negative, by end of day today. So in terms of the loan that's expiring, the current portion of the debt represents 55% of the total debt. So it's actually relatively significant amounts, about 500 million Singapore dollars that is up for renewal. And I think likely one of the things that we speculate that has been holding back this refinancing negotiation is the fact that there has been several announcements made by the chairman and the controlling shareholder, Mr. Chang, with regard to, for example, earlier in the year, I think in May, he announced there was this potential MOU for a strategic partnership with ARA. And so I think that also, we speculate that actually might have been the cause of, delaying the renegotiations, as the potential for the change in the trustee manager, ownership of the trustee manager, and as well as the shareholder, major shareholder, is sort of evaluated on the bank side. Yeah. So for those who know or may not know, earlier just last week, they also announced that they have scrapped the ARA MOU, and they are going and they have embarked on another, the chairman has embarked on another MOU with Ocean Capital. Yeah, if I'm not wrong, that's the name. So what happens now is that the chairman is going to sell a 70% stake in the trustee manager to this group, as well as up to 25% units of his own units. He currently owns about 53% of the Tasin's units. Yeah. Okay. So we think that in conclusion with this Tasin question, we think that likely we'll be looking at an extension of the loan rather than a refinancing, because, as you know, this new deal with Sino Ocean was just only proposed. So I think the management will need some time to, or rather the banks will need some time to actually evaluate the merits of this the financing and the loan term. Yeah. Okay. So there's another question on Parkway REIT, hold or take profit. So we don't have coverage on Parkway. What we do know is that the price has rolled up quite significantly just over this year to date. I think part of it is because the market has sort of priced in the master lease expiries, which just 4 days ago, I think it was a positive outcome for the renewal of the master leases. They actually managed to sign the new lease with which will actually expand, or rather extend, the yield to about 16.6 years. Yeah, so I think there was a little bit of like a speculation happening earlier on in the year, and also anticipation that these leases will be renewed, and so they have been renewed. And I think that the share price has sort of moved to adjust for this. Yeah, so we don't have a coverage on Parkway Life. Okay. I see a lot of TA questions. Okay, I think I saw one question earlier about the top 5 REITs, or top 5 REIT picks in terms of stable dividends. So I would say that, okay, yeah, sorry. The question here is, what is Phillip Research pick for the best 5 performing REITs in terms of stable growth and dividends? Okay, so for our own stock picks, the stocks that we have coverage on, we favor FCT as well as Ascendas REIT. These 2 REITs, in our view, are stable. FCT, Fraser Centrepoint Trust, as we know, they are suburban mall owners, and they have braved the pandemic relatively well because of their high proportion, their proximity to the household catchments, as well as their high portion, about 54% of their trade sectors are actually in the essential services categories. And of course, we like Ascendas because we view that industrials are the beneficials of this post-COVID era. The asset classes of your business parks, your logistics, your light industrials, which will support the manufacturing sector. These are, and as well as not to mention the data centers. So these are the asset classes that we believe will help to support the digital economy and moving forward. Yeah. So apart from these picks, in terms of so in our view, those 2 are the stable dividend picks. Yeah. Okay. We also favor Prime right now. So Prime is a US REIT, and they have actually a relatively good exposure to the new economies tenants. So those tenants include your life sciences tenants, your tech tenants, biomedical tenants, as well as some media and advertising tenants. So these tenants are the ones that are sort of better paymasters, and they are the ones that are actually driving up the market rents in the US. So of course, a larger exposure to these kind of new industry, new economy tenants will be beneficial in terms of your ability to command higher rents. And for Manulife, they actually for Prime, they actually have a relatively high yield of 8.5%. Yeah. Okay, so other REITs that we do not have coverage on, that we speculate are doing relatively well in this post-COVID environment, are also Cesio, I think, because as we know, the Chinese, they love their luxury and branded goods. So the Cesio REIT has benefited from the malls that actually house these luxury brands and the trapped China consumer dollars. Okay, so I think that's about it for me. Sorry, one last question here. With the new normal, work from home, how do you see office REITs in the future? So in terms of our sector preferences, we actually have a neutral outlook on the office sector. I think that is in part, of course, due to as you already mentioned, the work from home phenomena, as well as, of course, maybe not just work from home, but also flexible working arrangements that allow employees to work from home as well as from the office as and when they deem fit. So okay, so our neutral call on the office sector is because we believe that in the near term, while there are still renewals going on, there has also been a bit of a mixed signal. So some of the tenants have also been downsizing. There have been some expansions. We think that with the borders eventually opening up, we could potentially see more inflow from foreign companies that would like to set up headquarters in Singapore. Yeah. So, but overall, I think we still are relatively cautious on the office subsector. So I think that's about it for me. I will pass the time back to Paul.
Okay, thanks. Let me just try and answer some of the questions here. Do you answer this one, the update on China's effort towards REITs and all that? Yeah. Okay, let me do the one on Viacom. Viacom is on the decline. Is it worth holding for dividends? I think just a reminder. Just a reminder here. Viacom is they do vehicle inspection and they have like 75% market share in Singapore. So I think the earnings will be really resilient, and it actually went back to pre-pandemic levels. What has been troubling them has been the non-vehicle testing, which is a bit of a less publicity on that. They actually test, I think for construction, they test the equipment, they can test the soil, they even test the materials, the building materials. It is less publicity, less well known. The thing is that we're not sure how much of revenue comes from the non-vehicle testing. So that's the one that's been dragging. And I think if things recover, I think it's just a temporary weakness. And the cash flows are still good for Viacom. I know we don't directly cover it with True Comfort, but I think when you have 75% market share, I think your earnings should be quite resilient. So I think the dividends should be able to maintain. That's just my general comment. Hi, Poems. The next question, what are your views on semiconductor stocks and which SGX semiconductor is your pick and why? For us, we don't cover, but if we had to choose, I think UMS would be our preference. I think UMS is a easier way to identify as a beneficiary because UMS largest customer, or maybe perhaps the biggest, I don't know, maybe 70-80%, it comes from Applied Materials. And an Applied Materials customer is like Intel, TSMC, and they are all expanding their capacity. I think if you've seen some of our slides earlier, you can see that there's at least a 20-30% jump in capex for the next 2 years. So if you go to any foundry now, their capacity is all full. The lead time has probably doubled, tripled. And of course, all this is helpful for UMS because it means that they need more equipment, and UMS should be the beneficiary. AEM are not that familiar because it's quite complex. But the thing is that we're not sure of the next capex cycle from Intel. How much of it will they source from AEM? I really no idea. Yeah. So that's my uncertainty for me. Okay, let me just answer one or two more here. Thanks for the presentation. Referring to the US consumer chart that shot up to the roof, is it pent-up demand? Maybe not sustainable. Your thoughts on which stocks to catch up on the consumer sector strength? This is more of a US stock, so I can't really comment on US stocks. But in terms of what happened in terms of the retail sales, is of course a large part due to the stimulus. If I can recall, I think each American got like $1,000 for a one-off check. Number one, and I think those who were not employed were getting like $300 extra on top of the usual unemployment benefits which they got. I slipped my mind. I discussed it last time. And so the first stimulus that you got from Trump, I think people might have saved it, but the next stimulus people just spent it. So you can see from that phenomena. Is it pent-up demand? In a little bit of pent-up demand, but also there's a bit of huge stimulus. Stimulus by the Biden government that helped to ramp up. Is it sustainable? Probably not at these levels, because it's hard to say, because usually it's only 3-4%. So maybe we don't think it will be sustainable at these levels, because a lot of it has been sprouted up by the Biden stimulus. I mean, when you give out a handout like that, yeah, people will just spend it. Yeah, I hope that answers it. We can't give you consumer names. We don't cover the US stocks. Next question. Let's take two more questions before we end it. What do you think of the agri industry in this quarter? Will the increase in raw material costs impact them directly? For agri, the impact for their costs is mainly on fertilizer because it's all, and a bit of fuel cost because it's also all, and a bit of shipment cost. But I don't think cost will be the big factor. I think prices will be the big driver. Sorry, I don't really cover that much on agri, so I can't really comment much. So sorry for that. I think let me take the last one before I hand out to anyone else who has. Is UG dead in the water? I think my view of gloves right now in general is that there's a lot of uncertainty how much further glove prices will drop. I think everyone has their own views, and although earnings will be really good, I think it'll be record high. But I think the market, as one attendee rightly pointed out, that the market now views the big earnings you got as one-off. So it's just there's a lot of uncertainty. Where will the glove prices trend? So my thoughts are the share prices might be just trending sideways. In general, I mean, until we get some clarity, but we still like UG because of the valuations and so forth. But I mean, to be realistic, we know there's a lot of overhang because glove prices have started to taper down. So there's a bit of lack of clarity where would they trend down. But our forecast really assume like 30% drop in prices. But I think the market won't be comforted by that. They still want to see some better stability. Okay, I think we hit the 12:45. I still see lots of questions, a lot of TA questions. I think you can just go to our website and maybe Natalie can take on, then we can end it. Thanks.
Yeah, okay, sorry, I missed this question earlier. Can you give an update on China's efforts towards more focus on REITs and how both Dasin and Cecil are faring and what are the risks in investing? So for the China REITs, 9 of them were actually listed on the Shenzhen as well as the Shanghai Stock Exchange on the 21st of June, just a few weeks ago. So what happens for these 9 REITs, right? They are mostly in the industrial, warehouse, waste management, as well as tolls asset classes. And the reason why these are not traditional REIT asset classes that we see. Usually what we see are the office, your retail, some even do residential REITs, but not so much all of these like waste management and tolls. So for China, the reason why they have sort of relaxed their stance on REITs and allowed these REITs to list is basically to more to help with the municipal government's debt. Because in China, usually these projects are funded by the government. So to tap some of the China capital, they have allowed the listing of these REITs. And apparently these REITs were very well subscribed for when the IPO hit. That said, in terms of China REITs that will come out from the market, in the near term, it's very likely to be just within these industrial/infrastructure kind of asset classes, rather than the kind of asset classes that we traditionally see. And another thing is that these REITs are actually not open for foreign investors, so only Chinese investors can hold. So the competition with regard to Dasin as well as Cecil is that, of course, some of the unit holders of Dasin and Cecil may be Chinese nationals or Chinese corporations that may want to switch out into these REITs. But that being said, the asset classes are not comparable in that sense. Yeah. So at the time of listing, these REITs actually carry a yield of about 4% to 11.7%. Actually, only one of these REITs listed with an 11% yield. That was for REIT holding the toll assets. Yeah. Okay, so this just to provide some color. But yeah, in terms of competition, we don't really. I think the listing on the different exchanges already sort of indicates the kind of capital that these REITs wish to tap on. So by listing on the Singapore Exchange, these China REITs, being Dasin and Cecil or even BHG, they're actually sort of trying to capture the Singapore investor dollars rather than China dollars. So I think it's safe to say that a lot of the retail investors are those that are local Singaporeans, so Singapore incorporated companies. Okay, so I think that's about it for this question. I'll hand the time back to Paul for concluding remarks.
Okay, thanks, Natalie. So with that, we should end it because I think Varian has a 1 p.m. event. And I know there's still lots of TA questions. You can either join his Telegram group or just post your questions in our Stocks PMB chat. Any questions you have, we will try our best to answer. So thanks everyone for attending and hope to see you again next week. Okay, thank you everyone and take care. Bye-bye.